In this lesson, we will talk about the main income statement items that a firm will register throughout its business cycle. We have to start with revenue, also known as net sales. This item represents an inflow of economic resources. Usually, the main type of revenue for a given firm are its day-to-day sales, customers buying goods that the firm sells. There can be other sources of revenue as well. Companies can and do make money outside their core operations. For example, they can earn money by renting some of their real estate or by selling goods that they do not typically sell. The account that unites these sources of additional revenue is called other revenue. Okay, so this is the top line of the income statement. This is how the firm makes money. The sum of net sales and other revenue equals total revenue. Let's provide a practical example. Think of a dairy company. It produces milk and cheese and then sells it to chains of supermarkets. When the company sells milk and cheese on a daily basis, it registers sales, right? Its clients, the supermarket chains, have to pay for the goods that they have received. This is the firm's core business, and the amount of sales that the firm makes will be registered as net sales. At the same time, the company also rents out a real estate property that it owns and receives rental income for it. It will be registered as other revenue because this activity is not part of the core business of the firm. Such distinction is necessary because it allows us to separate sales coming from core business activities from income that is a result of non-core activities. And as we said before, the sum of net sales and other revenue equals total revenue. Below total revenue will be listed the firm's expenses, outflows of economic resources. In order to fuel its sales and produce the goods that it delivers to clients, the firm needs to sustain certain costs. The most common types of expenses are cost of goods sold, selling, general and administrative costs, depreciation and amortization, and interest expenses. Cost of goods sold are expenses that are necessary to produce the goods that the firm sells. Our dairy company needs to buy raw milk from local producers, transport, process, and then package it before it can sell it to the large supermarket chains. It sustains additional costs in order to produce cheese from the milk. All of the expenses that are directly attributable to the production of goods that are later sold are registered as cost of goods sold. The difference between total revenues and cost of goods sold is called gross profit. This is the profit a company makes after deducting the costs associated with making and selling its products. Selling, general, and administrative expenses are a large category of costs. The dairy company classifies here its expenses for advertising and promotions, salaries of its management and personnel that is not directly involved with production, accounting, office, and auxiliary personnel, rent for its offices, and utility bills such as electricity, phone, and water bills. Depreciation and amortization are two accounts that reflect the using up of tangible and intangible assets. Depreciation refers to assets of a physical nature, while amortization is the term that is used for intangible assets, goodwill, licenses, copyrights, etc. Every year, the plants that the dairy company owns become 1 year older, and therefore their value is reduced. In order to account for such reduction, the company registers a depreciation expense. Interest expenses are the costs that a company bears for receiving financing. Typically, firms receive bank loans and pay interest expenses for the amounts they owe. The dairy company, from our example, had to ask for a bank loan when it acquired a new milk processing system. The bank agreed to lend the necessary funds at an interest rate of 6%. Every year, the firm has to pay an interest expense on the amount that it still owes. Such interest expense is registered in the company's income statement. And finally, we have taxes. There are two things that no person can avoid, and one of them is paying taxes. Every firm pays corporate taxes that are proportional to the amount of pre-tax profit that it generated. The rules according to which the amount of pre-tax income generated by the firm is measured may vary depending on the country where the company operates. Once all expenses are considered, we arrive at the bottom line, which is called net income. This is the excess of revenues over expenses, the profitability of a venture after accounting for all costs. These are the typical items that you will find on an income statement. Later on in the course, we will go through a complete case study and show you how the items are registered and organized in order to form a complete statement. This will do for now. Thanks for watching.